Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill Kelly sits down with Melissa Ma, co-founder of Asia Alternatives, to explore the evolving landscape of private equity in Asia. Melissa shares her journey from Goldman Sachs to co-founding Asia Alternatives, providing deep insights into the firm's strategic focus on Asia's private equity markets. The discussion covers the significance of demographics, geopolitical risks, and the role of technology in shaping investment strategies. Listen in.
Melissa Ma, welcome to Educational Alpha.
Thank you, Bill. It's a pleasure to be here with you as always.
I'm looking forward to this. And I know you're based in San Francisco, but I run into you in places like Berlin and Hong Kong, more so than San Francisco. And you've been a proud, long-serving member of the Kaya board, having just stepped down after a very long stint. And you were a very effective and impactful board member. So at the get-go, I want to thank you for that service, because it was not only about the meeting itself, but you were tremendously helpful to myself and John Bowman and our colleagues around the world in terms of helping us better understand the market, because we're an educational provider, but we need to have our content informed by very, very smart people doing global things. And you check that box very strongly and soundly. And I do appreciate it. And maybe last accolade in that front, I don't think you maybe necessarily knew much about Kaya, but Jane Buchanan and Mark Anson, and I don't know what happened in that smoky back room, but they made you an offer you couldn't refuse. And I appreciate it.
Well, Bill, I want to thank you and John Bowman and the entire team. I felt like an imposter getting on the Kaya board, having never gotten a Kaya. And ever since I've gotten on the board, I have been trying, and I will ultimately succeed in studying and getting some form of Kaya designation. That is still on my to-do list. But the more I participated and met, how important the role of Kaya is into our global private alternative ecosystem is. And there really is nobody else that's kind of filling that role. And I hope that we can continue, both me and myself and Asia Alternatives, to bring this to Asia, because more than ever, if we need it globally, we need even more in some of these newer emerging private market areas.
I think that's all going to be germane in the course of this conversation today. I think somewhere around 20% of our members and candidates come out of Asia Pacific, but China more specifically, it's very, very small. And I think there's an opportunity there, because I think alternatives are probably more emerging than not in that part of the world to some degree. And as you think about opportunities to get the investment thesis right, if you could marry that up against sensible regulation and informed education, quality due diligence, you're onto something. So maybe there's a lot more we can do together, even though your governance role has changed. Sticking to the format of Educational Alpha, Melissa, maybe a little bit of your background. And I know you've had a couple of very interesting stations throughout the course of your career. And I don't know if that was all prep work or Asia Alternatives. I think you would have found it anyway and been successful, but maybe talk about some of your stops and what led you almost 20 years ago to the founding of Asia Alternatives.
No, I think without a doubt, if it had not been for some of the steps in the past, Asia Alternatives would not have been formed. So let me first just start by describing what we are. Asia Alternatives is a dedicated specialist Asia private equity fund of funds. So let me break that down. Okay. So first, as a specialist, we only invest in Asia. We don't do any other markets. Second, as private equity, we invest in buyouts, growth, and venture. We do have an ability to do some other private asset classes like special situations and others, but they are very, very little of what we do. And then last, by fund of funds, we do not have any other products. We don't raise direct funds. We don't have hedge funds. We don't have real estate funds, et cetera. Are a commingled fund. Within that fund of funds, we have primary funds. We buy secondary interests. And we also do participate in what I call direct co-investments, direct deals, but those are as co-investments as lines out of our managers. This was not an obvious path for me, or I think even for my partners when we first started with the idea in 2005. So as you said, it's been almost 20 years. We're in our 18th year. So I'll tell you my history, but that 100% weaves the history of my founders and how Asia Alternatives got started. So out of college, my first job was at Goldman Sachs on Wall Street. And that's when I met one of my first co-founders, Lori Wong. And after Goldman, I went to Harvard Business School, as did Lori, which is when we met our second co-founder, Rebecca Xu, who I know you've had the pleasure of meeting and who's helped with some of the Kaya activity in China. All three of us are Chinese by background. We're slightly different. I am a first generation. My parents immigrated to this country. I am a first generation, but I was born here in the United States. Lori is kind of the hybrid between the two of us. Lori was also born in the US, but she spent a good part of her childhood in Asia and is much more fluent than I am because her father moved the family back to Asia for a good period, and she went to school for part of Asia. And then we have Rebecca, who we used to call local. Rebecca was born in China, worked in China, and literally her first day out of China was her first day at Harvard Business School, if you can imagine. I laughed with her. I said, from the heart of communism to capitalism in one plane flight.
Wow.
That's how the three of us came together. After business school, we pursued very different paths. Rebecca and I went to McKinsey. I worked in McKinsey's Hong Kong office from 1995 to 2000. And then in 2000, I was transferred to San Francisco. During that period, I worked with Hellman and Friedman, helped found the private equity practice here in San Francisco. In 2003, I went in-house to Hellman and Friedman, and it was there that I had the great pleasure of working for the team in Hellman and Friedman, but specifically Warren Hellman himself. And Warren, tremendous mentor to us, but really is the reason Asia Alternatives was here. Lori, Rebecca, and I always had this view that it wasn't a question of if, it was just a question of when institutional investors would need to be adding more emerging markets to their private equity portfolios. This was as they're not just looking for geographic diversification, but as you know all too well, right? You need to add risk because you need alpha. And if you knew the demographic and you knew the socioeconomic trends, this was not hard to call, right? Over the next couple of decades, in my lifetime, and I would argue maybe my children's lifetime, the bulk of that emerging markets growth is going to be driven by Asia. So that is something that we dedicate our careers to. As I said, I worked at McKinsey in Asia. Then Rebecca, she also started with me at McKinsey, but then she joined the IFC in 1999 on the heels of the Asian financial crisis. They started the first fund of funds, I would argue the first true emerging markets fund of funds, in order to try to help get some of these struggling economies off the ground. That today is a very successful fund of funds program. And she was one of the founding members and helped found the Asia program. So she was already an LP in these markets. Lori, after business school, went back to Goldman Sachs, where she was part of the PIA group, the principal investing area. So she was a director investor and had been doing that for over a decade plus before she joined Asia Alt. So we all had experience on the ground in Asia in slightly different capacities, just not specifically in this idea of doing an Asia specialist fund of funds, because such a thing didn't exist. So in 2005, it's a little bit of a kooky idea. But as I said, we were driven not only by this view about the demographics and the wealth to be created in Asia, but we also believed that the right way to invest long-term sticky assets, these funds are 10 to 12-year funds, right? Can't pull your money out, is you need to invest in the trends that are not volatile, are not subject to cycles like commodities or potentially politics or exports. And the one thing you could count on over decades was domestic consumption, was demographics. It was not going to be a linear line. There were going to be bumps in the road, but that was the one direction that you knew. So if you were going to invest in domestic consumption, then ultimately the bulk of that value, as history has shown both in the US and Europe and any other major private equity market, is that's a backyard business. And you need local managers. So we believe that there was a real opportunity here to invest in, help seed, help create the local manager pool in these core markets that would eventually become the market leaders in a growing private equity pool. So that was really the thesis behind how we got started.
Congratulations on a very successful almost 2 decades, and I'm sure your very best days are ahead. Just a very quick small world story. We may have intersected in the offices of Hellman and Friedman way back when. And I don't know if I ever told you this, but in listening to you now, we were starting Boston Partners and we were looking for outside capital. We eventually went on our own, but I met Warren Hellman a couple of times, and God rest his soul, just a tremendous individual. And Matt Barger was involved. But the young analyst assigned to us was a young fellow by the name of Philip Hammarskjöld.
Oh, my gosh.
He was brand new and eventually became, I think, the CEO of Hellman and Friedman.
Yes, still there.
He was sort of the grunt who I was staying up with late at night, cranking out spreadsheets. And it's amazing. Small world.
Oh, my gosh. Yeah. I mean, just on that comment, I mean, Hellman and Friedman is celebrating their 40th anniversary. They're putting together a video.
Wow.
I was just asked to make a few words. And the word I used is, again, a very Asian word, is the Hellman Keiretsu. I mean, that's what happened. Think how many amazing firms, Farallon, Hall Capital, Osterweiss, the list can go on, that got created from the Hellman and Friedman ecosystem and from Warren himself. We consider ourselves very blessed to just be a very small part of that.
Yeah, it's really quite amazing. Back to Asia Alternatives. So you have now 6 funds, I believe. I assume the investment thesis has maybe changed and evolved over those 6 funds, and maybe the emphasis of a market like China, which is too big to ignore. It's been on the radar. I think geopolitical risk is very different today than it was maybe just a handful of years ago. And maybe the last observation, I'll let you run with this, Melissa. I know it's fair to cut the world into pre and post COVID, right, but coming out of the other side of COVID, we now have onshoring and nearshoring of supply chains. I think that's changed the investment dynamic. Maybe not better nor worse, but it's something an investor has to take into consideration. And the geopolitical risk is now a lot more in front of us as well. So how big is China in terms of the overall investment, not maybe fund specific, and how that's moved? And is it fair to think about the world pre and post COVID?
I feel like we could spend our entire podcast, Bill, talking about so many layers of that multifaceted question you asked me. Let me just first start with how we think about our portfolio construction and ultimately how we make investment decisions, because that's going to guide all the answers I give you. And that really is on a risk-adjusted return basis. What we tell our investors is, I'm not here to dictate a geographically diversified portfolio for you. You're going to get all of Asia because that's all I can do. But we do not promise slavishly, okay, X to Y% in China, A to B% in Japan, because in the end, first of all, these are evolving markets. Second, our whole purpose as a fund of funds is to deliver or exceed the return that we believe investors need to get compensated for taking the Asia risk. And that's all well and good theoretically, but what does that mean practically? So we break it down to 3 risks. There's the geographic risk, there's the illiquidity risk, there's the manager risk. So the geographic risk is, what is the risk premium that I need to deliver to investors to justify them investing in this specific Asia fund or asset or sub-asset class relative to that same asset class or sub-asset class in a more developed market? And we use the US as our benchmark. For example, like you would look at, okay, in Japan, a large buyout deal. How much more return should you expect to get for a Japan large buyout deal versus a similar situated deal in the US? And right now, we have a lower risk premium, maybe 200, 300 basis points to compensate for the Japan risk. That's how that works. The second, of course, is the age-old illiquidity risk. Everybody in private equity. What's the risk premium that I need to deliver to justify you investing in Asia private equity over Asia public equity? And here we haven't changed our risk premium since day one. We still use a 500 basis point risk premium, which is pretty high. And that is not only because it's Asia, but it's because if you look at, there's a huge variety of maturity and liquidity of public markets where we invest. Everything from Japan all the way up to China and India, et cetera. Very, very different public market dynamics. So on a overall basis, we still feel like that's a very appropriate. But if we feel like if we can deliver 500 basis points of risk premium over what you could get in a similarly situated public portfolio, you're getting compensated for taking that illiquidity risk. And then last but not least is, as you mentioned earlier, we are still one of the younger private equity markets. And therefore, you have a range of managers, people from their fund 1s all the way up to their fund 9s. I don't know if we don't have a lot of fund 10s, 11, 12s yet. And there, certainly, we believe in the age-old persistency of performance. which is if your first fund's in the top quartile, your second fund's in the top quartile, it's a pretty high probability. Your third fund will be in the top quartile, et cetera. So with that persistency of performance, so therefore we obviously have a higher risk premium for younger managers, a lower risk premium for later managers, especially if they've already had a track record of most of their funds being top funds. So that drives what we look at, which is our job is to scour Asia to find those opportunities opportunistically where you're more than compensating investors for the risks they're taking in Asia, and to build a risk diversified portfolio, not necessarily a geographically diversified portfolio. So if my first fund is a vintage year 2006 and my latest fund is a vintage year 2021, I mean, what's happened in the world, much less what's happened in China and Asia, is radically different. So therefore, the geographic mix and therefore the risk profile of each of these funds looks very different. These are very different investing environments. And our next fund, Fund 7, inevitably will do so as well for a number of the factors that you talked about. So what I would say on, you're asking, thinking about this pre-post pandemic, it is the right way to think about it from a timeline perspective, but it's not necessarily the pandemic that created this new norm that we're heading into, right? It probably just tipped it off. And so what I mean by that is there is no question in my mind and at Asia Alternatives' mind that we are, I don't want to say we're decoupling, because I don't think the US and China or the world can really truly decouple, despite what a lot of politicians might say. But we're definitely moving to a more polarized world, and a world where not only the number of bodies now and the bodies that are going to be born and are going to be the productive part of the workforce, but where the GDP is also shifting. And I know certain countries hate this word, but it really is to the global south, and the implication that that's going to have on everything we do, like you talked about, the onshoring, offshoring, the economic flows, domestic consumption, which we look at tremendously because that's our investment thesis, as well as geopolitics, is tremendous in ways that I don't really even think that we fully understand today. And we're just starting to see the beginnings of it in this geopolitical tensions between the US and China. But in many ways, you could also argue this was inevitable because this is the closest that China, the economic parity between China and the United States is coming closer than any other major superpower and a rising superpower has in 100 years. And so that's Thucydides' principle, where Graham Allison looked at kind of 17 different points in history where a rising superpower was starting to threaten the economic might of an existing superpower. And in 14 out of the 17 times, it erupted in conflict. Now, I don't think we need to worry about a military conflict. Both China and the United States, I feel like, are responsible adults, and their economic prosperity relies on peace, relies on world stability. It's going to be an economic and on the front of the technology. That's really what we're seeing right now, is this intense competition and intense threat that one superpower is feeling from another.
And I think those threats and risks and geopolitical risks, I don't know if it's fair to say they vary by industry, but I think they do, in that I think technology, cyber warfare, and AI, I think that's got a much more political undertone to it than perhaps other industries. Is that a fair statement?
When we think about the sectors overlay, Bill, what is sensitive in the short term is very hard to say, because you could argue some of the agriculture sectors, some of the sectors that affect jobs are very front and center right now. For example, there's a lobbying effort going on right now to put 100% tariffs on golf carts because there's only 2 golf cart makers and China dominates golf carts. So the US are lobbying to put tariffs because that essentially makes it very difficult for Chinese golf carts. How are we going to argue that the golf carts are strategic or hurting social interest? So I just use that example to say, all right, I don't think anything is off the table right now when it comes to this US-China tension. However, in the long term, it really is, in my mind, it is about a tech competition, which I also, and I usually get in trouble because I am just speak my mind, I also think in some ways is really silly. And that's probably why I can't be in politics, because I'm sitting here in Silicon Valley, investing in venture capital, being one of the largest investors in both China as well as India venture capital, I can tell you, and technology is not a zero-sum game. There's not a winner and a loser, and there is not long-term, I take one, you lose 2. It doesn't work that way. And in fact, the ecosystem, the technology ecosystems for China and the US are very, very different because of their governance systems and because of the pool of talent. And as a result of that, there are sectors and areas where China is inevitably going to be a market leader, and there are others that the United States is inevitably going to be a market leader. So if you just look at the data and you look at the top 5 market cap companies in every sector, how many are China, how many are US, and how many are the rest of the world? Software, there's not one single Chinese company. E-commerce, split. Green energy, EV, China dominates. I mean, I can go on and on and on by sectors. And this gets back to the differences in how capital, in how government policy, in the technology research infrastructure is, all sorts of things. And they lead to that. And so I just don't believe that restrictions and tariffs and things like that, they can put some short-term dislocation in it. I'm a believer in the free markets. I don't believe that long term this should or hopefully will not impede global technology progress.
So as you look into any country, China or India or Japan, are you sector agnostic, or do you have a sector specialty that is maybe sort of in your go zone?
So when we look at investments, we do it by what we call buckets. And so a bucket is China early stage venture, or Japan mid to late stage buyout, or India mid to large growth. You need to look at it by country, but you also need to look at it by sub asset class, because how you make money, lose money, each of these sub segments is very different. And so to just say I like China private equity or I don't is vastly underestimating, because what's happening today in the venture market, very different from the growth, very different from the buyout. And even within the venture, what's happening in the early stage market, very different from the late stage market. To say we are sector agnostic is not quite right. We are sector agnostic across many of our buckets, but in some of our buckets, we are not sector agnostic. So for example, today, to use your example in China, it is not prudent to be sector agnostic. We're not sector agnostic when it comes to early stage venture. There are what I call green light sectors. These are sectors where are aligned with the government's priorities, is aligned with China's future growth model. These are good investments. These are things EV, green energy, anything having to do with helping China become tech independence, infrastructure, semiconductors, etc. There are yellow light sectors, which are heavily regulated sectors, which doesn't mean you don't invest in them. It could be education, healthcare, but you have to be very careful, the subsector as well as the company. And then there's an increasing list of what we call red light sectors. These are sectors that private investors, I don't want to speak for all investors because I work in the private equity sector, but as a private equity investor, we will avoid, because they are either one, incompatible with the socialist value system. So a lot of sin driven, vaping, alcohol, drugs, things like that. But in addition to that, there is also now a new category of red light sectors, which are those sectors which the U.S. is and will likely view as a sensitive sector, both the U.S. and China. And so that there may be policy or investment restrictions on this. You can't be sector agnostic anymore in certain areas.
Just turning our attention to the other end of the pipe, which is exits. They certainly have been challenged, maybe around the world, but certainly in North America. And there's just so much capital was raised in the late teens and leading up to 2020. The plumbing got shut off, didn't get slowed down, got shut off. So not only did you need a bigger pipe on the exit side to have it closed down, and I think it's going to take a while to get this right-sided. Maybe now and then, as you look forward, what does a successful exit look like in Asia? And is it the same in North America? Is it a strategic buyer? Is it an IPO? How do you define a successful exit?
Well, a successful exit, Billy, on the day is when you get your cash. You get as much cash back as quickly as possible. Not stock, not deferred, but cash. But joking aside, this is why you have to take that bucket approach, because when we look at the ecosystem for each of these buckets, the exit part of the ecosystem looks extremely different and it evolves. So for example, we have just had record liquidity in the first half of this year in our Japan portfolio, probably 2 or 3 times an annualized run rate. But very little of it was public market. Exits, IPOs, doesn't mean we haven't had any, and it's been picking up, but that is not the predominant source. The predominant source are strategic exits, secondaries, other GPs buying our companies, foreign GPs a lot of times buying companies from our local Japanese companies, recaps or recapitalizations. And that's because, again, of what we know to be a very unique debt and interest rate environment in Japan. That can't exist in any other market, in our markets at least. If we go to the other end of the spectrum right now, which the big question is China, yes, I mean, liquidity has always been slower in China than in the equivalent of the North America, which is why the risk premium is higher. But that is because it's just earlier in its ecosystem. Until recently, we didn't have a lot of LBO funding. The debt markets were not there where you could do the easy flips, easy money, easy leverage. The strategic buyer base was just starting. And, from an IPO perspective, now that's actually been the greatest improvement in the last decade is the number of domestic avenues open for IPOs, both in Hong Kong with some relaxation of certain listing rules for certain sectors like biotech, but also the number of boards and the number of venues, which are now more registration based and approval based for IPOs. And so it's getting better, but that is still a market where IPOs are still very, very important. And other markets like India, for example, where we have a very technology base, up until a year or two ago, I could probably count on two hands the number of IPOs I'd had in the first decade. Not a heavily driven IPO market. So it varies greatly. I would just make one comment on liquidity because of the developing nature of some of the more traditional exit mechanisms that you have in the States. We talked about the debt markets, the MBO markets, right? The financing markets, as well as the secondary markets. These are all either starting in certain markets or really expanding. And so as a result of that, the drop in DPI that you saw in this last year, and I think, again, they're saying this year's going to be a tough year, was not as great in our portfolio or in Asia. It was already behind. It was already lower DPI to begin with, again, because of the less developed nature. But because the increasing development of that exit ecosystem has started to counterbalance that, we have actually, on a relative basis, not been that far off of our 5-year average in terms of total DPI per year.
As you indicate, I think that's showing maybe a bottoming. And you may have seen, I think, Bain's first half report that came out recently. I think they said the average LP has been DPI negative since 2019, but maybe not to the same degree. And we're starting to see some loosening up there too. So there's got to be the first signs of spring, even when there's snow on the ground still. And maybe we're starting to see some of those as well. A couple of other things I want to cover. I know that I mentioned your service in Kai, and thank you for that. I know you've been very involved with ILPA as well. And you sit in a very interesting seat because you're LP and GP. Mm-hmm. And I think you, more than most, can relate to the responsibilities of either one, trying to put yourself in the shoes of the other person. But I think what we've seen with the aforementioned stats about negative cash flow for some of these LPs, and they're struggling because they have beneficiaries to pay. How are we doing vis-a-vis transparency? Because we've had ILPA coming out, for instance, with views on NAV-based lending as an example. So there's been returns that have to be manufactured to some degree to get cash back as opposed to true economic returns. So maybe to bring that back to a question, what is the current state of affairs, LP-GP relationship? And is it working? It's never going to be perfect, but is it working better than it has been? Is there more we can do in that front? And you, as I said, have a foot in both camps.
You're talking about specifically in Asia, LPGP in Asia.
You probably know it globally, but maybe Asia would be interesting, yes.
What I say when it comes to any of these private equity trends is that Asia is certainly going to be the last. Either it's like for ESG, SRI, right? It was Europe first, then the United States, and then Asia is going to catch up. And the same thing, just by nature of the younger nature of these markets. So inevitably, there are very few trends that you're going to see in the US and the Europe that don't ultimately get to Asia. So with that in mind, though, what I would say right now is, again, it very much depends. It depends on the pendulum. We have markets right now where fundraising is extremely difficult, like China, where clearly the pendulum is swung in the LP's favor. And so terms, negotiations, getting more progress there, I would say, as an LP than we have in a long time. And then you swing yourself to other markets right now. And it's not for all funds, but certainly for those top decile funds in Japan and in India, where there seems to be a lot of people trying to shift money from China to India and Japan. I don't think that's the right thing to do. Not to say not do it, but I'm just saying you can't necessarily say I have $1 allocated to China, so I'm going to just reallocate that to Japan and India. They're very different markets, very different risk profiles, very different return profiles, but also the manager depth is very different as well. But nonetheless, it really is creating a very oversubscribed situation that neither of these markets are used to. The prior 10 years, these were very difficult markets to fundraise in. I think in those regards, the GPs clearly have the upper hand on the pendulum. with that, we are seeing some of them take advantage of it when it comes to economics. And so we're seeing some US like economics seeping in that I feel like is a little too, obviously we're putting my LP hat on, right? A little bit too premature for a market that has not quite delivered the scale of liquidity yet that I think it needs to command some of these premium terms. In terms of transparency, I think there's been tremendous progress over the last decade. Couple different ways. One, the more LPs, both domestic Asian LPs as well as international LPs that are investing in these funds and pushing on terms and negotiating certainly helped for transparency. The second is I think that a lot of the industry organizations like Kaya, like ILPA that you mentioned, we also participate in the Venture Capital Association. So for example, Rebecca, my partner, is the chairwoman of the Hong Kong Venture Capital Association. And I know these are all co-partners of yours over time. All of these organizations have started to also put increased emphasis and staffing and resources on Asia, including them in their global mandates. That is very important to be able for Asia to be part of that international community and to learn from other markets.
All fair points. Maybe one quick subset, and then I'll finish with sort of a broader outlook, which I have to assume, given your day job, is rosy. But maybe one subset of this transparency is ESG. And what that means, I'm not sure. It's measuring everything and nothing at the same time. I agree with your approach. I think Europe has been leading the charge, US, maybe APAC. But if you have a European investor, maybe they have certain expectations about being able to measure very, very specifically risks embedded in ESG. And let's just pick climate as an example. And maybe as part of your portfolio companies on an absolute basis, I don't know if they meet the screening or not, but on a relative basis, maybe it's moving in the right direction. So is ESG, maybe more specifically climate as an example, if APAC is not up to the same level of compliance that a European organization, say in oil and gas, might be, how does an investor get comfortable with that?
I'm glad you asked me specifically about climate because when you ask about ESG, as you know, the E, the S, and the G are totally different.
And incompatible to some degree.
Right. And I've always said, I don't know why it's ESG. I think it should be GES because without the G, there is no E, there's no S. There's nothing. And I think that as LPs that are focused on Asia, we may be more behind on the E and the S, but G has always been at the top of the forefront because we're not doing our fiduciary duty if we don't have good G. So with that as the overlay, then what I will also say is ESG is growing and it's growing by market. So as you can imagine, some markets like Australia, in Japan, there are dedicated climate funds, ESG funds, early, but other funds, right? In other markets like India and China, less so. Doesn't mean that these are bad countries. It just means that they don't quite have the investor interest to be able to justify those funds yet. And we do have a number of European investors who care very much about climate, and they do have ESG mandates. Well, first and foremost, we're a fund of funds. So that's the first thing I tell people. You don't have as much ability to measure underlying carbon footprint and climate metrics when you're a fund of funds. So that's the first choice. And so for people who can't ultimately get comfortable with that, they probably don't invest in fund of funds, or certainly not ones like ours. And then the second is that the way that we manage this is, by the way, we're a member of the UNPRI. We were one of the very first Asian members to join. And so we certainly uphold those principles. And we believe that one of the most effective ways that we can help the PRI principles in Asia is the governance. We sit on the advisory boards of most of the funds that we sit on. And these are some of the principles and some of the topics and some of the areas that we will raise at advisory boards. So there are these governance related areas, Bill, where I think we can make a difference and other LPs hopefully would together make an impact. But if it is where you've got to fill in this climate related data or carbon related data or nothing, very few, I think, Asia funds are going to meet that ticket.
I agree. In conclusion, maybe just broadly speaking, your outlook, Melissa, and I assume it's got to be good or you would close up shop. But also something that I don't think is talked about enough is demographics.
Absolutely.
And if I look at what's going on in Japan and China on the one hand, and then India has demographics to die for, that's going to drive the investment thesis as well. And as you said earlier, if I said to you, well, how much do you invest in China? You would say, well, what year are we talking about? Or what vintage are we talking about? Because you've got to find the very best opportunities in the markets and yield the very best risk-adjusted return, full stop. So your outlook, and then how important does demographics play into that outlook too?
Thank you, Bill, for this question. I mentioned earlier that when Lori, Rebecca, and I started Asia Alternatives, we built it on this domestic consumption thesis. So if you're going to bet your career on this cockamamie idea in 2005 on domestic consumption, the demographics is very important to us as well as domestic consumption patterns. So this is a big driver in how we think about our portfolio. So we all kind of know the headline message, right? That China has been overtaken by India as the most populous nation by a very small number. They both have 1.4 billion people, but we're rounding error after that. And that India will enjoy over the next decade the demographic dividend that China has enjoyed for the last decade plus. However, what I want to really introduce two concepts here, which is in the end, population itself does not equal GDP growth. We know that. Population translates into economic prosperity for two reasons. One, because it creates a consumable class. People can earn enough money to consume. And second, that demographics translates into productive labor force. I think that's often kind of missed there. And so, despite the fact that China is a slowing in the demographics, it's not going to look anywhere even close to where Japan is starting until 2050. And in the meantime, that productivity, that demographic gap, they're trying very hard to stem that tide by all sorts of measures and encouraging people to have babies, but also technology. There is a reason why China is a leader in robotics, because they are a manufacturing hub. Remember, I talked about the different tech ecosystems, right? The robotic industry, but the use of robotics as a substitute for labor is growing very quickly, and the technology is very impressive right now. And part of that is because obviously China is a huge manufacturing base, so the efficiencies, the cost efficiencies there, but also it's one of the keys to trying to fill what is inevitably going to be a labor force gap, which is what Japan is facing now. If they continue on their current path by 2040, and they don't stem the tide, they're going to have a 30 to 40% labor gap from where they are today. That's huge. And the economic impact of that's going to be huge. So that's one thing. The other is about education. So if we look at the number of college graduates, high school graduates that are coming out of China today, it's almost 12-fold what it was 10 years ago. And that is because of their push for education and their creation. So one of the reasons we have this youth unemployment is not just because the economy is slowing down, it's because there's so many college grads that have jobs now than there ever were. I think that just translating slowing down demographics and saying that inevitably means economic disparity, economic doom or whatever you want to call it, it's too simple of a formula. But putting this into context, if we look at what matters to us when we look at our investment thesis is consumption. Today, only 36% of China's GDP is by private consumption. And in India, it's already 60%. So even if China's growing slower, just changing the shape of and that's part of the transition the economy is making, which is shifting it to be more private consumption, it's got a long way to go because, it's only 1/3 roughly private consumption compared to over 60%. And by order of magnitude, both of these countries are still having tremendous adds to what we call the consumer class. So the consumer class is defined as a population that has at least $12 or more to spend a day. So from today through the end of 2030, China's going to add about 240 million people to the net addition of the consumer class, and India is going to add about 300. But that's 55% of the total net add globally to the consumer class. So these two countries alone are going to create 55% of the new people added to the world that actually have consumption capability. So while the demographics are going to change and move slowly, the impact of that is going to continue to be really what dominates GDP. So when we look again at the projections, we can look at the population. So by 2032, China will have 16% of the world's population compared to 18% today, so 2% less, and 17% of the labor force, which is 2% less. India is going to stay flat. It's about 18% of the population, about 19% labor force. So they're going to stay flat. But how does that translate to GDP? Still very hard. in these same numbers by 2032, India is still only 5% of the world's GDP and 7% of the GDP growth, versus China will increase its share of 18% of GDP to 22% of the world's GDP. So therefore, kind of to circle back, this is a long-winded answer, is to say what you really have to focus though on are all of those mechanisms that link demographics ultimately to consumption, ultimately to labor force, and ultimately to GDP. And we're still going to see, everybody asks me, oh, can India be the next China? No. At these numbers, India cannot be the next China, and it cannot be the new growth engine for the world to take over China's position.
A very interesting analysis. And I think it just shows, Melissa, that any stat can be taken out of proportion. And I think about just the business that Kaya's in from an educational standpoint, and you've chosen too. This is why performance dispersion is so wide. You have different theses, people react to them a different way, and you've shown why sober and thorough analysis is so very important. So thank you for that enlightenment throughout the 35, 40 minutes, but certainly I think that's a great way to end this. So I do want to thank you again. You've been a beacon of transparency and leadership for us, for the industry. And thank you for all that you do. And certainly I'm destined, despite my tenure at Kaya coming to an end, to see you hopefully early and often throughout many corners of the world.
Thank you, Bill. It's been a pleasure working with you, and I know our paths will continue to cross for many years.
Excellent. All the best. Thanks, Melissa. Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the Kaya Association and subscribe to the show at kaya.org. That's CAIA.org. See you next time.